I'm delighted to welcome our next guest, Jack Schwager, renowned author of Market Wizards, The New Market Wizards, Stock Market Wizards, Unknown Market Wizards, the best traders you've never heard of. No doubt everyone in finance who's ever been interested in trading has read at least one of his books, if not part of some of his books. Jack, I'm a huge fan of your work. A real honor to finally meet you. Welcome to the show.
Thank you, David. Glad to be here.
Like I mentioned offline, one of your books, The New Market Wizards, which you wrote in the early 90s, was required reading for one of my finance classes when I was at McGill. It was actually on the reading list. We had to read it. So, little starstruck to have finally met you virtually. Jack, I have so many questions for you regarding your past, your trading experiences, and of course the people you've talked to. My first question is, you probably get asked this question actually quite a lot, but who is the one trader of the many, many people you've interviewed who have actually changed the way you trade yourself?
Oh, um, well, I guess it's not just, I would say Bruce Kovner in a way because of one of the lines in his interview, which has stayed with me and which dominates my trading philosophy. And that one line certainly has more an impact on my personal trading than anything else. And it's also, I would say, uh, the one sentence, if I had to pick out of all the Market Wizard books, and I could only give one sentence of advice, it would be that line. And it's basically know where you will get out before you get in. And that one short sentence, 10 words, is so critical on multiple levels. First of all, it implies risk management, strict risk management, because you're deciding where you're going to get out, presuming you stick with your own plan. So you make that decision, so that limits the risk on any trade you might take. And the second part of it is it implies, implicit in that advice is the realization that you have much more clarity before you put on a trade than after. Because once you put on a trade, you lose objectivity. Everything that comes out, everything that particular market does, you view through a lens of hope. In some sense, I mean, not that hope is good, but as human beings, you want to interpret it in a way that's favorable to your position. But if you make a decision where you're going to get out of the position before you put it on, it's at a time where you're neutral and you can make a rational or the best rational choice. So if I had to pick one person that influenced my trading most, I would say it's Bruce through that just one sentence of advice.
Let's just talk about that for a minute. When you say knowing when to get out, are you talking about setting a price target? Are you talking about stop losses? In practical terms, what does that mean, Jack?
I am actually talking, in my case, I'm talking about stop losses. Okay, it's difficult to you can set where you think the trade can go and have an objective and all of that, but much more critical is knowing where you get out if the trade doesn't work for you. And if it does work for you, the trade evolves in certain ways that may change your mind or whatever. So I think it's not bad to have a target initially, to have some idea, but ultimately, I think the real critical aspect is the getting out when it doesn't work, because that keeps every trade from doing much damage.
Okay, interesting. I've heard about, I've talked to people about the idea of setting a price target, which is the notion that once a stock hits a certain level, that's when you get out. And this particular gentleman that I've spoken to this about, he said that he doesn't really believe in this principle because suppose you have a target of $10 for a stock and it's currently trading at 5, and you've arrived at that conclusion based on a number of valuation metrics that you set yourself. Well, the stock is trading at 10, you get out at 10 and it goes to $20. You've just missed out on $10 of upside. On the flip side, let's say if the stock goes to $9 and you're still waiting for an extra dollar and then it keeps going down, well, you've just lost out on an opportunity to sell when you should have. How would you respond to this gentleman's?
So I would say that's exactly right. I mean, that's why I say you can have a preliminary objective, but it shouldn't be anything rigid because, you know, as that trader indicated, you can both give up the potential to have much larger gains as well as give up the gains you have just sticking for your target. So personally, I kind of am in favor of the idea for most trades, raising the stop, raising the stop initially to break even when you can, as soon as you can do so, and then giving it room and raising it periodically. One way to do it, from a chart standpoint, one way to do it is market along the way. If, let's say you're long, in this particular case of stock, it consolidates and then starts going up again. You can then you can lift your stop in below the consolidation. That becomes a meaningful point. So now, if you got stop, then the market may reverse, stop you out, and you never hit your target. That's a good example. This way, you've at least protected part of the gains, and you've done so using a meaningful reversal in the stock in this particular case. And if the stock does keep on going, your $10 to $20 case, if you do this approach, it's quite possible you'll be able to ride it all along. Maybe not to the top, but you'll be able to ride more of it because you're just periodically raising the stop, always at the point where the market shouldn't get to.
And are there any indicators that you look for personally when it comes to raising or lowering your stops?
Yeah, let's like I said, you want to pick points which have some meaning and are not too close. So, as I indicated, one way to do it is use a consolidation, and then you get a breakout in your direction, going back after that breakout, going back below the consolidation is at least a sign of failure. Now it can go below and then reverse again, sure, but at least you're requiring the market to do some real damage before you get knocked out. So that's one way of doing it. That's basically it. So that's as good as any.
How do you feel about this year's rally in tech stocks, the Magnificent Seven, which pushed up the entire S&P 500? If you actually strip out those stocks and take a look at an index that doesn't have those stocks, for example, the Russell 2000, it's been flat, if not down on the year. Actually, it is down on the year. So just taking the tech stocks, for example, do you think they're fairly valued now, or perhaps some would say they're overstretched in terms of valuations? Did you look into that?
Yeah, I don't have I don't have much or any fundamental opinions I have are never down to the stock. I was never that was never my approach to look at stock fundamentals. If I trade stocks, it's strictly through, strictly on a chart basis. It's not through any company fundamentals. Now, I may have, again, mostly technically oriented, I may have an opinion on what the broad indexes look like from a technical standpoint, and that would influence my decision on individual stocks, but it's not the fundamentals on stocks. So, for example, if I happen to be negative on the market, so then I'll be looking for situations to short as opposed to buy. I'll be biased to looking for shorts in that example. So, but I'm not doing company fundamentals.
All right. Well, let's just take an example of a stock, and then I'd like to ask you about its technicals. And just the idea behind this question is just to get your philosophy and approach here. If you take a look at NVIDIA, for example, which started the year at around $150 a share, it's now currently trading at $435. It just kept rallying throughout the first two quarters. At a certain point, one would say, all right, you got 200% gains, it's enough. But it kept going up. When you look at technicals like that, and it just moves up in a straight line before finally consolidating, at what point do you think to yourself, enough's enough, it's time to take profits, assuming you got in before the beginning of the year?
Yeah, if you're in that fortunate situation, basically, when it starts going exponential, when the curve goes from basically linear up to exponentially up, those are usually types of blowout phases. Also, for stocks, you can you can look for high volume. So on the short side, by the way, I think it works much better on the short side than the long side. So you will see that there are lots of cases where stocks, particularly stocks that have had big up moves, can hit these very high volume days, and that can often, be in the vicinity of what a top is. So those are two things, excessively high volume days and exponential rise are things to be wary of. Also, uh, lots of bullish press coverage, and particularly watching financial news programs, uh, interview type programs. A lot of people pumping that stock. That's also a negative.
Your first book, Market Wizards, which came out, I believe, 1989. It's called Market Wizards, interviews with top traders, many prominent investors and traders featured in your book, including Richard Dennis. Paul Tudor Jones was interviewed. First of all, how did you come up with the inspiration of going about interviewing America's top traders? How did that?
Yeah,
Were you
I
trading at the
so
time? Yeah.
yeah. Well, I was a research director for well, the idea came out at that time. I believe I was with Payne Weber, but the idea came to. I should mention that. Well, the catalyst was really that I had written another book before. Most people don't realize that Market Wizards was my first big selling book, but it wasn't my first book. My first book was something called The Complete Guide to the Futures Markets, which was more of an analytical tone. And the book did well for what it was, and I got approached by another publisher, took me to lunch and wanted me to do a whole series of fundamental books. And I said, I had done that book on a sabbatical, and it's a like near 800-page book. Did a pre-PC day, so it was an immense amount of work. But I said, I don't want to do that. And then you do that type of a book, you don't sell that many copies. So I said I want to do more of a broad audience book. And I had known some really good traders, and I had this idea of what turned out to be Market Wizards. I just had a more than full-time job, and I just didn't see how I could do it. So, but I mentioned I had this idea. I said if I was doing anything else, I would want to do a more mass audience book. And he said, "Well, what is?" And they told me ideas. I said, "Well, why don't you do that then?" So that was the catalyst, and sort of I needed that push to get me to do it. And it was pretty much something that I did on nights and weekends, type of thing. I had the advantage of knowing a couple of great traders, which is one of the reasons maybe why I had the idea to begin with. And so those traders led to, like, I knew Michael Marcus, who was chapter one, personally. Through him, I knew Bruce Governor. I'd actually been at Commodities Corp for a year, working with Michael. And then through interviewing traders, they would recommend other traders, and I did some research and found other traders, and basically that's how the book came together.
And how did you make the initial selection of the people that you would interview?
Yeah, I was looking for the spectacular stories. So in the case, like for example, just the ones I mentioned, Marcus had taken a $30,000 account at Commodities Corp and turned it into 80 million. I knew that for a fact. I mean, I'd been at the firm. Um, Bruce Kovner, who we hired incidentally, uh, um, had it when by the time he was internally, at that time, he was still internally within, he hadn't formed Caxton yet. He was still inside of Commodities Corp. So he had a return of like 88% over about a 9-year period or something. So those were like spectacular records. And then there were people that were known. I mean, like Richard Dennis. The story was well known. I mean, the guy had turned a couple $100 into a couple hundred million. So there were some spectacular stories out there that people knew. Um, yeah, so that's I was looking for. I was looking not. I wasn't looking just for good performance. I was looking for the spectacular performers.
I'm just curious, as a fellow interviewer, how did you convince them to sit down with you and divulge some of their secrets in a public
Yeah,
interview that will be published in a book?
yeah. So that's well, some cases it was people personally knowing me. So um, in fact, Bruce Coveners, he actually said to me, and Bruce Covenant, by the way, is an example of one of the quite a few people that I have interviewed who never gave another interview. And he said, as far as I know, and he said, maybe you may be wondering why I agreed to do this. And he said, because like I've gotten bigger now, and stories are starting to appear about me in the press, and I just want one record out there that I will trust is accurate. So he trusted me to be, honest in my interview. So, but one of the tricks I've used, or not tricks, but one of the things, approaches I've used that from the very beginning, which I think has been instrumental to my getting people to be honest and open up, is I tell them, you'll be able to see the finished interview before it gets printed. And if you think I got anything wrong, or there's something that you need to be changed, then we'll come, I won't print it without your permission. So it doesn't mean that I would, they'll tell me how to do it, but basically we'll come to some sort of compromise. Okay, either sometimes you have to take something out, or sometimes you have to change the wording or whatever. So in that way, I kind of give them a bit of peace of mind, saying no, they don't have to. Otherwise, the traders would be self-censoring constantly, because if you know it's going to be appearing in a book, people will always be kind of just carefully thinking and holding back and being careful in what they say. So this way, and the other thing, that's one thing. Another thing that's helped me greatly is sometimes the length of the interviews. So I could think of an example like Bill Lipschitz, who at the time, I guess he had just come off of being a trader at Solomon, and he had traded currency options at Solomon, and in size, but like billions of dollars size. So anyway, in his interview, it seemed like a good story, and so I interviewed him in his apartment, and for a couple of hours, nothing. And then we stopped. He ordered in Chinese food or something. We were eating. The recorder wasn't on, and then he's coming up with interesting stuff. So finally, look, you gotta. Well, let's cover that. So, and then we went back, and so none of the first few hours of the interview appears in the book. All the material that I used came after the first few hours, and that's not, in a number of cases, that's what happened. It was just by the length of the interview, things come out that don't come out initially.
You've interviewed a wide spectrum of people, traders, technicals to fundamentals, to people who look at everything in between, and a bit of both. And they've all had the common characteristic of having performed very well. Have you ever just thought about why it is that completely different approaches can lead to similarly good results? You've got people like Jim Rogers, who would never, in your own words, never do well as a technician, and you've got other people who are technical analysts who, like yourself, don't look at company fundamentals. Two completely different sciences or schools of thought that all lead to money making. Why is that?
Yeah. So actually, that's your point. There is one when I give talks. It's often I use that particular example, and I use interestingly enough, I use Jim Rogers. Jim Rogers, when I asked him, do you ever look at a chart? And it's almost like he was admitting a sin, saying, "Well, if I want to see where the price has been or some history, but do I believe any of this?" And he lists off some technical terms, and he said, "Well, yes, that's all a bunch of garbage." And on the other hand, you have somebody like Marty Schwartz, who says, I spent 10 years on fundamentals, lost money every year, and I got rich as a technician. So you got really totally opposite viewpoints. And so what I draw from that is that there's value in fundamentals, there's value in technical. Both approaches have value, and there's value in mixing the two. But both approaches are not right for everybody. People are very, very different, and not everybody. The same approach won't be right for everybody. So if you take somebody like Ed Thorpe, who's a brilliant PhD mathematician, his approach is going to be quite different than somebody who's kind of just finished high school, right? So just because of the difference in, say, quantability in that case, but also people have biases. They either believe in technical orientation, technical methods, or they believe in fundamentals, and that belief system really dictates a lot of what may work for them, and also what's comfortable for them to use. So one example, one reason I don't use fundamentals, and I started out as somebody, and not on stocks, but I came from the futures world, but I started out as somebody who never used charts, and only tried to use fundamentals. And I tried to build, price forecasting models and stuff like that. And I ultimately ended up just being purely technical. But my problem with fundamentals was that it didn't give you a way for risk management, at least not for me. So to me, the fundamentals almost seem to fight risk management, right? So if I do a model and it says, well, the market should top out at 35 cents, and there's nothing, the market can go to 70 cents. There's not, the more it goes, the higher it goes, the more it will seem overpriced. And that ended up being the big problem for me.
The technical analysts that you've interviewed, and perhaps you can, even answer this on behalf of yourself if you, follow this methodology. I'm assuming technical analysts don't believe in the random walk theory, which is that prices are completely random. Yesterday's prices, historical patterns, don't really mean much when it comes to predicting what's next, right?
Right. I mean, I would say not only that, I would say basically, all successful traders don't believe it, because they think their own experience just refutes the idea that the markets are a true random walk. Now they have aspects of the random walk. They have significant aspects of efficiency. They actually behave in a way that's, in many cases, very close to efficiency, but they also have radical departures from that. And I think whether people are fundamental or technical, they who were successful in trading the markets will come to that conclusion. So, from as a fundamental example, so traders, let's say, give you an example. Martin Taylor, who was in hedge fund market wizards, he started out as an emerging market analyst, but ultimately he was trading, both emerging markets and developed markets. But I interviewed him at a time, and at the time he had two of his main positions. He was long Apple and he was short RIM. And but let's look at the Apple one. So this was a point where his biggest loss at the time, and his big drawdowns were like between 15 and 20%. Those were his biggest. And he was one of those cases, when I was interviewing him, he was in a drawdown that was like close to 15%, and it was all one stock. It was Apple. So he was totally convinced that the market was wrong, that he was right, and his basic argument was that the market is, and he looked at the earnings forecasts going forward, and he says these earnings forecasts, they're just allowing for the current markets that Apple is in. They're not allowing for the expansion into China and and elsewhere. And it's going to be just dramatically larger growth in Apple than the earnings forecasts are. So and the fact that the market had come down made it all the more attractive. So in his mind, there was no doubt. I mean, I'm thinking particularly somebody who's a pure fundamentalist here. In his mind, there was no doubt that the market was totally mispricing it, because Yes, he believed he understood it much better than the market did. So that's an example of where if it's not a random market, the markets aren't the market isn't efficient, the market is being inefficient, and he's seeing it. So it's true for both fundamentals and technical of not believing the efficient market hypothesis.
Okay, let's talk about efficient market hypothesis. So I interviewed, some would argue, the father of the efficient market hypothesis, Eugene Fama, who won the Nobel Prize for his work on this issue. He is staunch advocate of this theory, and he believes that in his mind that markets are efficient, and he believes that people who beat the markets are statistical anomalies who can't really do it consistently in a long period of time. If they do, they just got lucky. And so his work opened up, I guess it opened up the entire passive management industry. If you had a conversation with him today, and what would you ask him?
Okay. What do I ask him, or what do I think of the opinion?
Well, what do you think of his theory first? Do you believe markets are
Okay, so
efficient?
so I've got a book called Market Sense and Nonsense. I got an entire chapter on why the efficient market hypothesis is wrong. With plenty of examples and reasoning and all that. But I will tell you the big reason why it's wrong is because it doesn't account for psychology in the markets. Bubbles and crashes both take the markets way too high and way too low. And you can't explain it. A perfect example, NASDAQ. NASDAQ, late 1990s, end of the 1999. So in an 18-month period from late 1988 to the peak in March 2000, the NASDAQ, in the internet, not the NASDAQ, but let me focus specifically on the internet stocks, that index went up like 600% in 18 months. And, it was all this hype. Then that same index goes down like 80%, equivalent to, in the next 19 months, almost the same amount of time, it goes down all the way where it came from. So you had it going up 600% and coming all the way down in a 3-year, approximately a little more than 3 years time period. And if you look for news, it's not like a whole bunch of new bullish news was coming out during the big up move and a whole bunch of new bearish news coming out. These were tech companies. A lot of those companies never had a hope of making money, but during the hype, they were going crazy. And then when the musical chairs stopped and, and it started going the other way, there was no bottom. So the market was not right in pricing those markets. If a stock went from $10 to 200 and down to zero, the market was never right in pricing it at 200 or 150 or even 50 or even 20. It was just all psychology, emotions influencing the market. So the behavior markets, there's lots of. My favorite example is Richard Thaler, who's one of the famous behavioral economists. I've read some of his books. Obviously, I also saw him in person once, giving a talk when I lived in Seattle, and he had my favorite. I had a lot of examples in my own book, but this was one that had come up, and it was just I loved it. So this was a stock that was it was a what do you call it, a closed mutual fund stock, and it basically had the initials, I think, of CUBA, like Cuba or something like that. And then so this mutual fund sort of went up, not mutual fund, this closed-end fund went up in one day. It went up like 70%. Usually they sell at a discount, the closed-end funds. It went from a discount to a 70% premium to its portfolio. And then, of course, came all the way down. The thing was, Obama came out and it said, it was beginning to normalize relationships with Cuba. And the irony was that the portfolio had no Cuban stocks. There are no Cuban stocks. You couldn't invest in Cuban stocks. And anyway, it was just the name. And the market went up like from 20% discount to a 70% premium in one day. So you can come up with a million examples of why it's wrong. But I will say one proviso on Farmer's case: most people are better off acting as if it were correct. as if the efficient market hypothesis was correct, because it is difficult to beat the markets. And most people would be better off investing in a just index fund that operates on the assumption of the efficient market hypothesis, because for them they will be better off because they don't have any edge in the markets.
One of the premises of the theory is that it's not to say that you can't make money as a passive investor if the markets go up. Obviously, you do. It's just that you can't consistently beat the markets unless you have asymmetrical information, which is to say, almost like insider information, which you act on it. Do you agree or disagree with that?
I'll answer for one example. Ed Thorpe ran a fund 19 years. In 19 years, he had 3 losing months, all less than 1%. Okay. I calculated using a binomial distribution, which is a conservative way because his wins were bigger than his losses, and I was just taking the assumption that they were equal. The probability of getting his track record, if markets were random, was equivalent to picking an atom. And I calculated this actually, picking an atom from the mass of the Earth and then randomly picking the same atom again. In fact, the odds of doing that are about 10 trillion times greater than Ed Thorpe's, based on conservative distribution assumption. So it's like impossible. His record would be totally impossible. I mean, totally impossible if the markets are random. Oh, he did it because he kept on coming in with innovations that exploited inefficiencies in the market. So he developed the mathematical equivalent of the Black-Scholes model years before the paper was published. So there was a period of time that for years, this guy was the only person in the world that I know that knew how to price options. And he was like printing money. And then he figured out statistical arbitrage before he developed that. And then he as these things became popular, he went on to something else. Then he figured out convertible arbitrage, where the optionality in bonds was mispriced. And so he would find these mathematical inefficiencies in the market and would exploit them. And that's how he did it, yeah. So he became the casino.
Now, the people who did beat markets on a semi-consistent basis, was there a similarity in their approach if you were to analyze one practitioner versus another? The hedge funds that did the best, for example, were there similarities?
No, I think they were all pretty much different. And whether they made money more consistently or not, and a lot of these traders didn't necessarily make money with consistency, and that's an important point. A large number of the traders I interviewed actually didn't have consistency. They were making their money because they were finding asymmetric opportunities. So their gains would come in spikes, and the idea was not to lose too much when not lose when things weren't there. But their gains were not smooth. It wasn't like every month they were making 2% or something like that. It was more like spurts where they would hit a big trade and then consolidate.
Well, what's more important for a trader, being a good forecaster or being good at risk management?
The traders I interviewed would, if you asked them all that question and I had to predict, I would give you 10 to 1 odds that they would say risk management.
Is that because they're not, the track record for forecasting was not good and they don't try to do that?
No, it's because every successful trader came to realize that without risk management, you will ultimately fail. And so it's just a matter of time. So they almost everyone, really emphasized the importance of risk management. And a number of them went through periods of failure and didn't succeed until they got the point of risk management.
You wrote a series of books starting from the late 80s all the way to the 2000s. Did you notice differences or an evolution in trading styles throughout the 20 years that you've been doing this?
No, I noticed a tremendous difference in the markets. From when I started writing these books, we've gone from trading, trading in trading pits to purely electronic trading. We've seen we've gone from pre-PC, where the first market wizard people, their track records were mainly established pre-PC days, to points where you have enormous computer power. You have big data, you have AI, more recent years. You have the advent of giant quant firms. I mean, firms with hundreds of quant PhDs, multiple, quite a number of these firms, which have hundreds of PhDs working on, using quant methods on the markets. So all of that has changed, but as far as seeing a pattern among the traders change, no, I don't. They're just different. And the one example I can think of a trader methodology change is a person whose approach would not have been possible when I first started writing. And that's somebody in the most recent book called Chris Camillo, who doesn't use fundamentals and doesn't use technical, but he uses social media sentiment. So there is an approach which couldn't have existed pre-computer age, and it's an approach that's outside the realm of what most people, including myself, had considered the 100% universe of approachable methods, since it's neither fundamental nor technical.
There's variations of that method. The algo bots trading on news headlines. Federal Reserve meeting releases at 2 p.m. Eastern. Within 5 nanoseconds, a trade is placed. Are they successful long term? They must be. It's a huge industry.
Yeah, again, there's some traders in the most recent book, Unknown Market Wizards, who trade on events only, like Fed announcements and stuff like that. And I think of one of them in particular. I mean, is a good example. He's just made an intense study of these things, and sort of knows a whole of. I mean, he's like a walking encyclopedia of all these type of events, and keeps meticulous notes, and will review similar situations. He comes into any type of event situation totally prepared for what words might be uttered and how it'll react.
I remember in my finance classes, more than one of my professors told us to not, if we ever become professional traders, not do this unless you work for a large fund using these algorithms, because you have bots that are able to trade on the news within microseconds that you'll never beat in terms of timing. In fact, people have moved their offices closer to the NASDAQ with the NYSE just to get their cable shorter so they can trade 5 nanoseconds faster. You'll never beat them, they said. How would you respond?
And he's right. I mean, so I would agree, definitely there's that edge. And so the trader I mentioned, for example, I mean, he had to adapt. He had to adapt that, there's the programs could be faster than he is, but he knows how to. But the markets move with not just the first move. There'll be the first move reactions and so forth. So he's adjusted for that, and still will use the event to trade, but recognizing that he'll be beat by the automated programs.
I do hope you revisit this series again and interview traders using modern technology. I'm referring to, we're entering the dawn of AI, and the big question on a lot of people's minds is whether or not computers can replace human traders altogether and one day, beat the markets without any human input. Is that a future that you see could happen?
Well, a quick way to be wrong, or a guaranteed way to be wrong, is to bet against technology's capabilities. But I still think it's nowhere near. And I mean, people use the example of chess. There was a time where there was so many combinations in chess. People thought it'd be impossibility for a computer to beat a master. But of course, I don't know, 8-10 years ago, we passed that point, and no master can come close to beating a computer anymore. But the thing about markets is they're vastly more complex than chess, or Go for that matter, because the same thing, we saw the same story happen with Go, where they thought that was Go was unbeatable, and then a few years ago, it did beat the best Go player. Um, but the thing that's different about markets is not only that there are so many variabilities. I mean, so many different economies, so many different companies, so many different things. But the really big thing is how the markets behave to given inputs changes. So it's not like physics, or it's not like a game of chess or Go where there's rules. In markets, the rules change all the time, and that's what makes it so exceedingly complex. So you can have times where an unemployment report comes out and it's surprisingly, positive for the economy, and it'll be bullish for the market, and other times it'll be bearish for the market. The same type of news can work both ways. Talking about keeping it within bonds and stocks, you can have times where bonds and stocks are moving up together. You have times where they're moving opposite. You can have times where they have no effect on each other. And that's just a few examples, but all these various variabilities are always changing in how the market reacts and what's important. And things that are very important end up ultimately sometimes being completely unimportant, and the effects reverse. So those changing rules, so to speak, make it exceedingly complicated and difficult. And AI is great because of recognizing patterns, but those patterns change.
Well, in your books, you've outlined, well, not so much in your books, but in other interviews that you've done, you've outlined similarities between very successful traders, and you've said that some of the traits that they all share is a common understanding of separating emotions from your trades, discipline, perseverance. It sounds like a computer could excel at this game if you were to completely remove emotions from the equation. Ultimately, what I'm trying to ask you, Jack, is what does a successful human trader have that a computer does not currently? What separates a bot from a Paul Tudor Jones or a Stanley Druckenmiller?
Yeah. Yes, I think this, in some cases, it might be a bit of an intuition. And by intuition, there's nothing mystical about it. Intuition is kind of a learned experience, a subconscious experience, I should say. I think, well, I'll use Marcus as an example because I still remember this. At the time, I knew him, we used to have lunch together. And, I was an economist, economics background, and did models and the stock market. And I kind of was looking for a peak in like mid 30s, and he was like dismissive. And this was, the market was like in the 25 areas, 25 cent area. And he said, no, it's going to go much, much higher. And the thing is, I went back and I did a study of every cotton market post World War II and all that. Marcus did none of that, but he kind of understood that this was the first year that the PRC had become a buyer of American cotton, and it was a big deal. And he understood that that was going to be the driver. So he could pick out the 1 out of 100 factors that was going to be the driver. He just had that kind of market sense to know what was the dominant factor. And so, a computer can pick out what things have been important in the past, but you get something new. Like this was new. First time PRT is a buyer. No way AI can pick that up, really, I don't think, because it's not a pattern that's there before. And even if it picked it up, it wouldn't have a way of knowing that was going to be enough to take the market from 25 cents to 99, like quadrupling the prices. So that's an example. I think these traders have a certain sense of the market, but of course, computers do excel in certain quant methods, and humans probably can't beat them in that approach. And yeah, and not having emotions. Yeah, the point you had of computers being free of emotions is correct. That is a definite edge as well.
Why is it that having emotional discipline and control gives you an edge as a trader? We hear that all the time, but why? How does that translate to actual results?
Because, and here I'm going to quote Bill Eckhart. He said, he says, we as humans will do worse than random. Why? Because we've evolved to seek comfort, and the markets don't pay off for being comfortable. And he's basically saying that just we've evolved, our own evolutionary processes make us makes our basic instincts just wrong to win at the markets. And so when he says the humans will do worse than random, that's then he's saying that they'll do worse than the proverbial chimpanzee throwing darts at the Wall Street page, because that's a random process where humans going on their instincts will make worse than random decisions. You could see it in, if you look at statistics, let's say, of people who take money in and out of a mutual fund. Almost invariably, they'll do worse than the mutual fund. Whatever, doesn't make a difference which fund it is. They'll always end up doing worse. Their decisions make things worse. It's just human nature. One perfect example, Joel Greenblatt. I won't go into his whole story and everything, but one of the things he did is he had a website at one time where he would put out, and he's a value trader, and he would put out their best picks. And he had this thing where you could take their best picks and just invest on your own, or you could have them manage the portfolio. And then it tells me, like, after a number of years, they did an analysis. They found out that even though it was the same list of stocks, the people that managed the money on their own, they threw away all the edge that was there. You know, all the positive returns just evaporated. So I asked him, why was that? And he said, well, there's a couple of reasons, but probably one of the big reasons was that some of the best performers were the most hated stocks. You know, so those ended up being the best performers. And so he said, but human nature is the stock is getting beaten down so much, it's all this bad news, and here it is on his recommendation, and they're not going to take that. Oh, I'll skip that one. But that ends up, because it'd be very uncomfortable to take that one. I mean, it looks so horrible. There's so much bad news. But that ends up being the one that you should take. So that's just human emotions will lead you wrong.
Well, Jack, thank you very much. What are you working on these days? Are you writing another book? How can we follow your work?
Yeah, I'm not actually, well, I'm involved on a consulting basis with a firm called Fundseeder, which is a website that people can link their accounts to and, you know, get their performance analytics. But the objective of the firm is to basically find traders that are unknown. In fact, some of the unknown market wizards came from that website. To find traders that are unknown, who are actually, you know, very good and could be investable. So that's I'm involved in that.
Your Market Wizards books aren't really written in sort of a serious format where you have to read one before the
Oh,
other
right,
for it to make
right.
sense.
Yeah.
So I'm just wondering, if someone is not familiar with your work now, which of these books should they start with? Does that matter?
That's I can only go by, well, either probably the first Market Wizards, because that seems to be a perennial favorite to some extent, or maybe the most unknown market, which is most recent, because it's the most recent. And for some people, interestingly enough, you know, enough people say that's their favorite. But again, I don't know if it really makes a difference, because if you look at reviews, like reader reviews, people have picked different Market Wizard books as their favorite. Some people like hedge fund Market Wizards because, you know, some of those interviews are a little more, you know, particularly if they're finance oriented, some of those are a little bit more involved. But everybody has their favorites. I don't think it makes that much a difference. But I would maybe say first one, either the first one, Market Wizards, or second, or the last one, Unknown Market Wizards. But the order doesn't make any difference.
Well, I encourage the audience to check out all of Jack's work and his current involvement with the website. We'll put the link down below. So please check it out. Read his books. You'll learn a lot. Jack, absolute honor again to finally have met you and spoken with you. I'm sure a lot of my peers from college would watch this interview and be very envious of me. So thank you very much, and I appreciate your time.
Yeah, pleasure, David. Thank you.
Thank you. And don't forget to like and subscribe.